Welcome, and thank you for joining us today. Thorley Wealth Management is excited to host the Beyond the Numbers, an economic and market update by Brad McMillan. Before we get started with our program today, please let me take a few minutes to orient you to the format. All attendees have been placed on mute. Our presentation is expected to last approximately 30 minutes, and we have left time at the end to address questions that were submitted prior to the start of today's presentation. If you have additional questions after our event, please contact us at Thorley Wealth Management. Our contact information is available at our website, thorleywm.com, and you can always email me directly at ethorley@thorleywm.com. I'm pleased to announce and introduce Brad McMillan, Managing Principal, Chief Investment Officer at Commonwealth. As Chief Investment Officer, Brad chairs the Investment Committee and is the primary spokesperson for Commonwealth's investment divisions. Brad received his BA from Dartmouth College, an MS from MIT, and an MS from Boston College. He's worked as a real estate developer, consultant, and lender, as an investment analyst, manager, and consultant, and as a startup executive. He has started and run several companies. Other professional qualifications include designated membership in the Appraisal Institute, the Chartered Financial Analyst Institute, and the Chartered Alternative Investment Analyst Association. Brad speaks extensively with the media, including the Wall Street Journal, CNBC, and Bloomberg, on investment and economic issues, and writes for industry publications, as well as on his daily blog, The Independent Market Observer. He's traveled widely around the world, and in his free time, Brad reads extensively in history, math, and science, and plays golf. He and his wife, Nora, have a son who is 12 years old. Let me now turn it over to Brad to start our program.
Thank you very much, Elizabeth, and thank you all for coming and watching. What I want to talk about today is, as you might imagine, the economy and the markets and the coronavirus, because the truth of the matter is that, let me get this back running here again. The truth of the matter is that the coronavirus is largely what we're talking about right now more than anything else. There we go. It's always a little more complicated than you think it is. So let's see here. I've only done this 100 times, right? So what I want to talk about, though, is you're going to see a lot of stuff in the headlines about different numbers. You know, this is how many new cases per day. This is the growth rate. These are the number of people who have been laid off or have gotten their jobs back. And a lot of the media coverage deals exclusively in those numbers and in basically trying to frighten you with them. So I do want to look at the numbers, but I also want to go beyond the numbers. I want to take a look at what those numbers mean and give you some context. Ideally, when we finish up here, you'll be able to watch the numbers and understand where they're going and what that means for the future and why. So let's get started here. I think it's important to establish a baseline as to where we are. And I think that there are a couple of key points that I want to start off with. First of all, the virus is still under control. Cases are stable and the spread rate is still low. That's an important place to start because right now we're starting to get some headlines. Things are accelerating, things are getting worse, it's out of control. It's not true. We've seen the cases go up a bit, that's true, but that was after seeing them decline for several days. So when you look at the 7-day average, we're just about where we were a couple of weeks ago. In other words, we're still doing okay. Now, that is not to say we're out of the woods. That bump that we've seen recently, we saw the number of cases drop and then we saw it bounce back, and we'll look at this in more detail. But the question we have to ask here, and we don't know the answer yet, is that bounce back just normal, things are steady, or does it reflect more viral growth from the Labor Day events, from schools reopening? That's a question we're not going to know the answer to for the next couple of weeks. And that's one of the things that we do need to keep an eye on. But at the same time, we do know the virus is under control at the moment. And that's an important baseline to talking about this. The next point is this, the economy. The recovery is continuing. The economy is continuing to come back. Things are continuing to get better. But we've seen the economy come back very, very quickly since March, quicker than almost anyone would have expected. And you hear about the V-shaped recovery, about things going down and then bouncing right back up. That's largely what we've seen so far. It's probably not going to continue. We are very probably going to see a much slower recovery going forward. And that's something we need to be cautious about. Because as we start to look at the markets, markets are largely expecting perfection. They're expecting that bounce back to continue. They're expecting things to continue to get better the way they have been, and they may not get it. And in fact, some of the recent volatility we've seen is the market coming to terms with that fact. So this is where we are today. And we'll go through the numbers, we'll go through the data to show why we are where we are. And then we'll talk about where we are probably going to end up going and what we'll need to watch in the coming weeks to see where we're going. So let's carry on. When you talk about a virus, the expression going viral, that means this explosive growth. You know, on day 0, nobody's ever heard of the dog riding a skateboard video. And on day 10, everybody in the whole world has seen the dog riding the skateboard. The whole thing about viral growth is that it doesn't proceed in a linear fashion. It doesn't add, say, 10 cases a day, 10 cases a day, 10 cases a day, 10 cases a day, because that would be something that could be controlled. Instead, it grows at a constant percentage rate. In other words, if it grows 10% a day, the number of cases will double every week. Think about that. In 1 month, you have 2, 4, 8, 16 times as many cases. That's what makes viral growth so scary. And that is what was happening in the early stages of the epidemic. We saw cases increasing, known cases, I should say, increasing at 20 or 30% a day. The number of cases was doubling 2 or 3 times during the course of a week. The number of people with the sickness was exploding. And that is exactly what started to break the healthcare system in New York. Just too many cases too fast. So the first thing we had to do was drop that percentage down. And in fact, that's exactly what we did. This doesn't go all the way back to the start of the pandemic. But what we did was we took the growth rate down from 20 or 30% a day down to about 1% a day. You can see that on the left side of the chart. And the blue line is the US cases. We got it down to 1% a day. We flattened the curve because the number of cases goes up like this at 20%. It goes up like that at 1%. And the healthcare system could handle that. So in the middle of June, we actually pretty much had things under control at that 1%, 1.25% a day. Not great. It still needed to keep improving, but at that point, the virus was under control. But then something happened. People said, okay, we've got this. We've got it under control. The problem is over. People started letting down their guard. States started reopening again. And in fact, the virus started to spread faster again. It doubled. Here at 1%, the number of cases doubles every 10 weeks. Here at 2%, the number of cases doubles every 5 weeks. And you can see here it was going up again. And in fact, if you look at the July 4th events, they started to kick in too, and we saw more growth, and it kept it up there. And that was a problem, because if you remember, that was what we heard about on the media as the second wave. But then once again, we knew what to do. We did it, and it worked. And we've actually driven the case growth rate back down below the 1% where we were, down to about 0.5%. In other words, the curve is even flatter than it was. We've got the virus more under control from a growth rate perspective than we did then. Now, that said, the number of cases is higher because we're dealing with a higher base number of cases. But nonetheless, from a spread perspective, from a control perspective, we're in a pretty good place. But then what you can also see here is that spread rate is flattened out around 0.5% to 0.75%, just as it flattened out in the 1 to 1.25 back here. And the question is it going to go up again? Is it going to stay steady, or is it going to go down? Well, the daily new cases, when you look at this, I said they're higher than they were, okay? But you can see here, up until a week or two ago, the trend was clearly down. We were getting fewer new cases every day. It varies. Friday is the day with the largest numbers. Sunday is the day with the least. But you can see that clear downward trend, but then something else happened. In the past week, we've seen that start to level up. And as I say, on the 7-day average, it came here, it dropped, and then it leveled up again. So we seem to have stabilized. When you look at that, that's very consistent with what we've seen in the percentage growth rate. But it also says that we're probably, unless things change, we're going to continue to get about 40,000 cases a day going forward. The question we have to ask ourselves is this post-Labor Day school openings the start of a new trend, or is this just things leveling out? There's a reason to believe that this is leveling out, and that reason is that when you look at the number of new infections in colleges, it's going up. When you look at the number of new infections outside of colleges, it's still going down. And if that's the case, and if the two offset each other, we're probably going to stay about even. We don't know that yet. That's something we need to keep an eye on over the next couple of weeks, the next 2 to 4 weeks. If the number of cases ticks above 40,000 on a sustained basis, that's a sign that says, okay, maybe we're in for another series of outbreaks. We don't know that. The signs are not that that's happening yet, but that's what we need to keep an eye on. Some good news here is that even as the number of cases has the potential for starting to tick up, the number of tests has started to trend up again. We saw the number of tests per day trending up until mid-July, and then it started to trend down a bit. Recently, we've seen it pick up again, and that's actually a good sign because we need more testing. And even though it's been very volatile, you can see that we are doing more tests. That's a good thing. An even better thing is this. When you look at the number of positive tests out there, we shouldn't just be testing the people we think are sick. We should be testing as many people as we can. And a measure of the success of that is the number of positive tests. It should be under 5% because we should be doing enough tests that we're capturing only about 5% of the people who are actually sick. And we've managed to stay under there for the past couple of weeks. So the testing news is good. Yes, we're seeing the infection stabilize, but we're seeing the testing stay under control. So again, this is a positive sign. So again, something we need to keep an eye on, but nonetheless, the early signs for the post-Labor Day or for the school openings are positive. The risk is still there, but right now, it could be a lot worse. And that's really the story. The pandemic is still under control, and this is where we started, with the caveat for now. The spread rate is still low. The control measures are working, and we're keeping the case count stable. Watch the headlines. If it goes above 40,000, that's something we need to pay attention to. And it might, because of the Labor Day openings, we saw cases spike after July 4th. School reopenings. These are things that might push the infection rate up again, but it hasn't yet. Good sign, because we might have seen it by now if it did. So I think we can be cautiously, very cautiously, optimistic going forward. But the thing is, because we don't know, because these medical risks are very real, we've seen the reopening efforts, what's been driving the economic recovery, start to slow down and even reverse in a number of states. This chart comes from the New York Times. You can see there's a number of states, including some very large states, that are actually reversing the reopening. They're actually starting to shut down again, or at least impose limits. We're seeing more states that are pausing. And when you look here, even though large parts of the country are indeed reopened, by and large, they're not the most economically active states. So this is a real headwind for the economic recovery. And it says that, yeah, we can see where the slowing in the recovery is coming from. And in fact, we can see this in the statistics as well. Because when you look at job gains here, one of the most damaging parts of this pandemic has been simply the fact that people were laid off. They were laid off for medical reasons. It was a good decision, but you lose your job, you're in trouble. And you can see that we lost over 20 million jobs, almost 25 million jobs all told in March and April. That's a huge hit. And we've seen jobs come back in a very big way. You know, we've seen millions of people return to work, but that bounce is slowing. We're seeing the pace of hiring slowing again. And that's something that's concerning, because the truth of the matter is, even as fewer people are getting hired back, people are getting laid off at about the same rate. We saw the initial layoffs and they've come down substantially, but recently they've leveled off. So in other words, fewer people are getting hired. People are getting hired. I want to be clear about that. But about the same number of people are getting laid off. And we're seeing all this, and we're only halfway back with the jobs. We went from about 153 million people working down to about 130 million. We lost 20 odd million jobs. And now we've brought about half of them back. And it's going to take a lot longer than 3 or 4 months to get the other half back. It gets worse than that, though, because when you look at the jobs that have been brought back, the highest wage workers, people making over $60,000 a year, were pretty much back to pre-pandemic hiring levels as of the middle of July. Most of those folks were back at work. The mid-wage people, 27 to 60,000 a year, almost all of those were back to work, 95%. And it's gotten better since then. It's the people with low wages that have taken the brunt of the layoffs. It's the people with low wages that haven't been brought back to work. And it's these people who, of course, are least able to weather that kind of economic hit. These people, by and large, have resources. They can live through this. These folks can't. And it was that reason, those people, that the federal government's income support program, the $600 a week unemployment bump up, was intended to help. And it worked. These people needed the money. These people got the money by and large, although the programs weren't perfect. And these people spent the money. And that is largely what has driven the V-shaped recovery thus far. Now, the $600 a week program expired. The supplemental $300 a week program is about to expire. What are those people going to do? Well, they're not going to be spending the money they don't have. And that's going to be another economic headwind we need to pay attention to. And again, when you go to the statistics, you can see how this plays out. These are two different consumer confidence numbers. You don't really need to pay attention to the numbers, but what I want you to see is this. In March and April, consumer confidence tanked. It went down very, very far. And then it bounced back. And again, that was at the time the federal income support program. We had people desperately worried about what was going to happen. And then we had people realizing, okay, we're going to be okay. And then it turned out they're not going to be okay. Low consumer confidence, no money, that means consumers are not going to be able or willing to spend. And that's over 2/3 of the economy. And that, as I say, is what has driven most of the V-shaped recovery thus far. The recovery will continue. We do have half of the jobs back. Consumer confidence is still not down at the levels of 2008, 2009, but it's going to be a headwind. And you can see that directly when you look at the consumer spending growth. This compares to where we were at the start of the pandemic. We came back very nicely, and then we were continuing to improve, but just recently we've turned down again. This reflects less confidence. This reflects less money. This reflects a slower recovery. And we need to pay attention to that. Now, that's not to say all the news is bad. In fact, business is very confident. This is what's called a diffusion index. If it's below 50, business is contracting. It's a survey, so it's companies around the country. It's reasonably representative. If it's above 50, business is confident and expanding. You can see here, you can see the damage in the 2000 bust. You can see the damage in the financial crisis. You can see the damage at the start of the pandemic, and you can see that it's bounced back. It's actually above where it was in most of 2019. Business is actually investing. Business is continuing to hire. This is a very positive sign. Hopefully, this will give us some pickup to make up for some of the loss of momentum we have from consumers. But in any event, this should help going forward. And in fact, when you look at the numbers, we continue to see things doing much better than expected. This is the economic surprise index. Everybody loves a surprise, right? Well, when the news comes out better than expected, you can see here that the news was much worse than expected during the start of the pandemic, actually worse to the same degree we saw in the financial crisis. But then we saw it bounce back to a degree we've never seen before. And that's the V-shaped recovery right there. But even there, we start to see it coming down, still doing very well, but it's starting to slow. And as I say, that's something we need to watch. And that's where we are today. I mean, we've made real progress getting back. Things are still much, much better than we could have imagined they'd be a couple of months ago. That V-shaped recovery was not in the cards, but we've done very well. But now we've done the easy stuff and we're starting to get into the tough stuff. We see slowing job growth and that's hitting confidence. We see retail spending pulling down. And the question is going to be, how much damage is that going to do? And how much is it going to be offset by business stepping up? Some of it will be, some of it won't be. I think on balance, we're going to see the recovery continue, but it's going to be a lot slower. And that's going to affect everything going forward here, especially the financial markets. Because you can see what this does, this shows for the S&P 500. 500 large companies, big part of the economy, fairly representative. And you can see here that earnings dropped by about 50%, by about half in the first quarter of this year. And they're going to drop by just under that in the second quarter. In other words, companies got killed. There's the damage. It's real. We saw the markets drop, but what we're also seeing is we're expecting to see the markets come back. We're expecting to see companies make as much money early next year as they did in 2019. That's a remarkable change. The markets are basically expecting the economy to be almost fully back next year. It could happen, but it's looking increasingly difficult. It could happen, but it's looking increasingly unlikely. And it could happen, and it better happen because that's what markets are expecting. And in fact, markets are expecting it to happen because when you look at valuations, if you feel really good about your life, you're going to go out and buy a fancier car, right? You're going to spend more money. Well, investors are very much like that because if they think the future is bright, they're going to spend more for stocks. And the way stocks are priced is this. How many years of earnings are you willing to pay for the stock market? The stock market collectively is going to make $100 and you'll spend $1,000 to buy that thing. That's what's called a price earnings ratio of 10 to 1. Well, right now we're at about 23 to 1. Think about that, because the thing is, that's higher than it's ever been. It's higher than it's ever been. Something to keep an eye on. Something to pay attention to. Actually, as I should say, it's the highest it's ever been on this chart. It was higher briefly in 2000, but I don't find that comparison to be particularly comforting. So the stock market has a lot of good news baked in. The stock market is expecting the economy to recover. The stock market is expecting everything to go right. And I'm in my mid-50s. I've learned that things don't always go right. So this is something I'm cautious about. And again, something we need to watch. And this is where we are. The virus is under control. but there's real risks over the next month. And what we need to watch on that is the daily number of new cases. If it goes meaningfully above 40,000, that's something we need to pay attention to. The economic recovery is continuing, but it is slowing. And what we need to watch there is how many jobs are created and how many people are laid off. Another thing to watch is whether there's another federal income support program, because that could make a huge difference. For the markets, we saw the markets hit new highs at the start of the month. But we've seen some recent turbulence as the market tries to figure out just how bad those risks are. And again, this is something to pay attention to, but the reality is, right now the economy is still growing and the fundamentals are actually not that bad. Pay attention to, don't panic. And that, I think, if you're going to take one thing away at the end, is conditions are still good. Conditions are still favorable, medical, economic, and market conditions, but the risks are rising. And there are things we need to pay attention to. There are things we are paying attention to. Elizabeth is paying attention to on your behalf. If you like to follow this sort of thing, I have a blog, The Independent Market Observer. We do lots of things here, and I will leave the disclaimers to Elizabeth to read. Elizabeth, over to you.
Thank you, Brad. We'll leave the disclaimers up for people to read for their own. So thank you for your insights and your perspectives. They're very much appreciated. And I always appreciate how well you explain and take a somewhat complex subject matter and make it understandable. And I've heard that from many clients over the years that have listened to your commentary. And I so wholeheartedly agree with that. Before today's event, we asked for questions from attendees. And as I mentioned at the start of the presentation, if you have questions that do not get answered, please feel free to reach out to any of us at Thorley Wealth Management or email me directly at ethorley@ethorleywm.com. So let's get started, Brad, with our first question. The attendee commented, I keep reading about all the issues we're facing in the next few months. Contentious elections, uncertainty around when we're getting a vaccine, and social unrest around the country. If I think this is going to cause the markets to decline, why not just get out of the markets and wait until things get better? What do you say to that, Brad?
I think that's a great question and a great observation. And if you could know when the markets were going to decline, I would be wholeheartedly in favor of doing that. But let me give you some examples where that might not have been the case. Just recently, when we go back to March, the market dropped 30-odd% in a matter of days. And we had a pandemic like we've never, ever, ever seen before coming. And the real narrative was it's the zombie apocalypse. Well, if you had said, okay, the market has dropped, I'm down 30%, I'm selling. And I know people who did.
Right.
You would have missed the run up since then. If you had sold at the financial crisis, you would have missed all of the run up since then. So it's easy to make the decision to sell. But unless you're willing to back in, buy back in, you're going to end up missing on all the future gains. It's not one decision, it's two decisions. When do you sell? When do you buy back in? I don't know people, but I know advisors who have clients who sold in 2008 and have not bought back in yet. So if you can call the market, if you know when it's going to go down and you know when it's going to go back up, by all means, you should absolutely do that. I'm not that smart, and neither is anybody I know.
You haven't found those people yet. Yes, it is a two decisions: when to get out, when to get back in. Hard to time. We don't have that crystal ball working, do we?
It's easy to get out.
Yes.
Getting back in is the tough part.
Yeah. So this was an interesting question, Brad. It said, when things get crazy in the markets, like in March, which we just talked about, what do you do to keep calm and grounded? how do you manage the emotional side of investing? Do you have any tips or advice around this?
Well, two things. First of all, I would say I take a walk. If you spend your day looking at the screen, and this isn't just economics, this is politics or anything else, you are going to go crazy. I'm already crazy enough. I don't need to be any crazier. So I walk away. Most of the news is not news. Most of the news is just designed to sell advertising and get you to click on something else. So I turn it off. And I can't give you better advice than that. Unfortunately, given my job, I can't just turn it off all the time. So what I do is, it's easy to get upset when you don't have any context, when you don't have any understanding of what's going on. I have spent most of my career trying to figure out what matters and what doesn't. And if you keep your eye on the things that really matter, you actually know you have a much better idea of what is signal and what is noise. To give you an example, and I think you were there for this one, Elizabeth, actually. I was at a conference back at the start of 2016, and the market had been going up and going down, and it was down pretty substantially. And I was getting questions from the people there. Is this it? Is this the big one? And I said, no, I don't think so. And I went through the reasons. I said, the economy is fine. Hiring is good. Consumer confidence is good. Business confidence is good. Interest rates are fine. I said, I think this is noise. And I was right. On the other hand, back in 2006, 2007, I was called Eeyore because I was one of the people, yeah, you remember that. I was one of the people who was saying, we got a problem here, we got a problem here. And I can't claim I knew how bad it was going to be because I didn't. Yeah. But you could see the train coming down the tracks. And in both cases, nobody wanted to hear it. So if you look at the fundamentals of things that really matter, and that's what I do on the blog. You know, I do a market risk index, I do an economic risk index, I talk about different things. That gives you something to anchor yourself to. Being able to anchor yourself to the facts and to know why they matter makes it much easier to hold tight and to not go crazy when things really start moving around.
Good advice. I would also say, add to that I always focus on what you can control and the things you can't control. And
great advice. Focus
on what you can control.
Great advice.
So our next question is, and I've heard this one quite a bit. I don't understand why the market has increased. We have a lot of people out of work, as you just showed us, in a lot of industries like restaurants, hospitality, airlines that are struggling. Why is there a disconnect? The market's going up, but the economy doesn't seem to be doing so well.
Well, I would put it this way. There's a lot of people out there who have been laid off who have it tough. I certainly acknowledge that. And that's a real problem, as I've said. But at the same time, there's a lot of people out there who have gone back to their jobs who can spend money. And the stock market is largely filled with the kind of companies, Apple, Microsoft, they cater to the people with money. So their businesses are doing just fine. We have the small local restaurants, they're going out of business. We have Apple that's posting record profits. And it's simply a matter of, these are two different things. People think the stock market is the economy. And over time, there's a connection. But when you look at what's actually in the stock market, you have multi-billion-dollar corporations. They have access to financing. They have access to other markets outside the US. It's simply not the same thing. It's natural to think they would be connected, and over time they will be. But Apple's business is doing fine. Peloton's business is doing fine. You know, and the folks who get laid off from the local restaurant, or the local restaurant that got shut down, and trust me, that's a tragedy. I have friends in that business, I know, but it's just not the same thing at all. So it's equivalent to saying, well, I know a local lawyer who's doing really well, while the landscaping guy doesn't have any business. Yeah, they're both part of the local economy, but they're doing different things. And that ultimately is the explanation.
Very helpful. So we haven't heard much about this from you yet today. So what are your thoughts about the upcoming elections?
What election? There's a lot of headlines about that. And, you know, I think I don't take a political stance, as you well know, Elizabeth, but I think what we can do is kind of step back and say, okay, if we're really going to think about this, how do we think about it? Well, let's look at the possible outcomes. Okay, one, presumably a civil disorder, the country falls apart, rioting. I don't actually think that's going to happen. But if it does, trust me, your portfolio is not what you're going to be worrying about. So let's set that aside. By the way, that was kind of a joke because I really don't think that's going to happen. So we have two possible outcomes. Trump wins or Biden wins. If Trump wins, the Republicans retain the Senate, almost certainly, and we're where we are right now. Okay? So from an investment point of view, status quo ante. If Biden wins, suppose the Republicans retain the Senate. In that case, well, we're pretty much where we are right now. We're not going to get anything radical through the Senate. Okay, we're where we are right now. No changes. It's only if Biden wins and the Democrats take the Senate that it gets interesting from an economic policy point of view. And even there, a lot of the coverage assumes that Biden is a socialist. I'm from Delaware. Biden was my senator. He used to date my mother's roommate in college. I actually know Biden. You know, he's not a socialist. Put a different way, who actually got the Republican nomination or the Democrat nomination? Was it Alexandria Ocasio-Cortez? No. Was it Bernie? No. It was Uncle Joe, the most centrist of the candidates. Who did he pick as his running mate? A pro-police attorney general. Yes, she's a woman. Yes, she's a woman of color. But if you ask the leftists, and I know a bunch of them, if she's a leftist, they'll laugh at you. You have the most centrist possible ticket from a Democrat that you're ever going to get. And when you look at the Democratic Party, when you look at the Democrats in the Senate, you have people like Joe Manchin in West Virginia. He's nobody's idea of a leftist. And there are a bunch of others out there who simply aren't going to sign off on anything crazy. And that's even assuming the Democrats could pass things, which they can't do unless either they get a filibuster-proof majority or they eliminate the filibuster. Now, I got to be honest with you, eliminating the filibuster is looking more realistic than it did a week ago. But I still don't think it's going to happen because that came back to bite them and bite them hard in the matter of Supreme Court justices. So I don't know that they would do that again, but they might. But even there, you've got kind of the Democrats, the senators are not that leftist. So I don't see socialism in our time from a policy perspective.
So do you think that there will be, and I'm sure that there will be, industries that will benefit under either presidency, and would you be an advocate or looking to emphasize some of those industries depending on who gets in office?
Well, I think if President Trump is reelected, I think any industry that benefits from less regulation will continue to do well. That would be energy, that would be financials, that would be materials. You know, whereas if the Democrats get into office and take control of the Senate, I think healthcare is going to do well. I think you're going to see a lot more potentially in terms of income support for people. So you're going to see consumer staples and consumer discretionary do well. But again, what happens, that's more of a tactical tilt. And the other thing to remember is for all of the headlines out there about it's the end of the world economically if the Democrats win, history shows us that stock market returns under Democrats are about twice what they are with Republicans.
Yes.
That's not politics, that's math. Just shoot the messenger, but it is what it is.
Yeah.
So again, as an investor, tactical tilts, but I think you're going to be okay either way.
Great. So that concludes the questions that we had sent in from our friends and clients. So again, Brad, I appreciate your time. I know that clients appreciate your independent observer blog and the market updates that we send out from you periodically. And I think I've also sent you questions and responses that I've received from my clients after listening to your commentary. So again, thank you for your time today. And anyone who has questions that didn't get answered, please email them to me, ethorley@thorleywm.com. Enjoy the rest of your week, and we will talk with you soon. Thank you.
Great to see you, Elizabeth. Take care.
Thank you, Brad.